move on, let's talk about Gokaldas Exports then on that note. Let's try and understand whether or not, they're eyeing more global territories. How's the India business shaping up? What are the new deals and synergies which are emerging right now for them? We have with us Sivaramakrishnan Ganapathi joining in on the show, the MD at Gokaldas Exports on the show right now. Sivaram, great to have you today on the show. Morning, firstly. As per your expectations, export demand was expected to pick up in the second half because of the holiday season. Has that panned out as to what you had anticipated?
Good morning and thank you for having me. These, as we had indicated since quite some time, the second half of this year is looking much better. We are already seeing a fairly robust order book for the third quarter, and the early indications for fourth quarter is also very strong. So we seem to be, entering into a phase where we will see some reasonable growth after a bit of a stagnation over the last several quarters. So this was anticipated because the US market was saturate with excess inventory. Most of the brands have managed to clear it out. And for spring 24 and summer 24, they seem to be coming to buy more garments from suppliers like us. So we are seeing a fairly good traction going forward.
That's quite nice. Could you put it in numbers though? What's the kind of volume and value growth that one can expect for the full year?
We are in a quiet period, so I would be very, cagey about sharing too many volumes and values. But, suffice to say, this Q3 over previous Q3, there is going to be a reasonably strong growth, so that is expected. Even on a linear basis, Q2 to Q3, we will see fairly reasonable growth, given that last 3-4 quarters were fairly stagnant.
Sure. I want to talk about Atraco's acquisition because you've clearly ensured duty-free access to some of the key markets, doubled your capacity as well. What are the synergies that you expect in terms of revenue as well as margin growth, and how do you think all of it is going to play out?
So Atraco, effectively will come in the fourth quarter for us because we are awaiting regulatory approvals from various countries that they operate in. So by the time we finish all of that, it'll take time. But from a synergy perspective, the customers that Atraco has are very different from the customers that we have, barring one. So there's only one common customer. So we will have access to their customers. They will have access to our customers for cross-selling, upselling, etc., going forward into the future. So that's one upside I'm seeing. There's also a lot of capacity expansion scope in the Atraco side of the business. And we've already chalked out a plan for that. So in the next 2 years, we anticipate an overall growth from current levels of 100-odd million to, we probably will grow by anywhere at a minimum 25%, most likely about 30% growth over 2 years. So that's another upside that we see on that side. And again, being a duty-free region, the attractiveness of that region will always be higher compared to any others because the overall landed cost for the buyer will be a lot less. So overall, I see that side of the business also is expected to do well, while we are also seeing a fairly good traction on the India side too.
All right. Now, given that several CapEx plans are underway, can you just highlight the capacity utilization, how you're looking to ramp that up? What's the optimum utilization that you're targeting?
So I believe that, when we reach the fourth quarter, we should be at near full capacity utilization. At the moment, we are operating at about anywhere between 85% and 90% capacity utilization at the moment. When I say at the moment, it's, end of Q2, early Q3. But as we go forward, our capacity utilization will be almost full, given how the order book is shaping up. So that's there. We've added a new capacity, which we brought on stream in June 2023, which is in Madhya Pradesh. So that came literally on stream in the second quarter. And in the second quarter, there will be a lot of startup costs because we were ramping up the manpower. A lot of people were in training and far fewer in production. So all those extra costs we are carrying. But going forward, I think, after 2-3 quarters, that unit will also start contributing. But for now, the Madhya Pradesh capacity utilization, the newest unit, is only to the extent of 10-15%. So in that has a scope for growing. All the other capacities that we have, we will very shortly, in a week or so, will be operating at near 100%.
Okay, and what is the outlook then on your margins? The consistent margin improvement has been seen at least over the last 5 years. Do you think that as the scale benefits kick in, as we're seeing investments in backward integration, what is your long-term margin that you're expecting?
So if I take a long-term view, so when I say a long-term view, say 2 to 3 years view, a 3-year view, I would expect that our margins can improve by 1.5%, 150 basis points. In the short run, it will be under stress, etc., because the first half has been stressful for this year, and globally the supply is in excess of demand, so there's all margin pressure. But I think we will recover from the second half and going forward into FY24, FY25 as well. So in a 3-year time frame, I would reckon that we could improve our EBITDA margin by 1.5%.
As we understand, you also have plans to foray into the knitwear segment and are setting up capacities as well for the same, right? So when is it that you expect to commence and ramp up these facilities? And this almost doubles your addressable market as well. So how will your sales mix eventually evolve?
So knitwear is a new venture for us. We're largely a wovens company, and by end of the third quarter, we will be most likely commissioning our knitwear fabric processing unit, and then we will start ramping it up over the next 1 to 2 years. So at its peak, our knitwear will be about 15% of our business. So it's still small in the scheme of things, particularly given that our woven side of business is also growing very fast. But over a period of time, we would like to balance it out as much as possible. So we will focus a little more on knitwear growth going forward.
Okay, interesting. Also, given the ongoing capex, the debt taken for Atraco, what is the debt trajectory that you expect now for the full year?
So by the end of this year, I'm anticipating, or maybe in the first quarter of next year, we will be having a debt of about $40 million US. That's primarily for Atraco acquisition. From a current business perspective, anyway, we have net cash, so there's barely any debt in the company, and cash reserves of 350 odd crores is far in excess of any debt. So net cash is that value. But going forward, I think we will have a $40 million debt, primarily for Atraco's acquisition. And on the Atraco side, we may also have a $15 million working capital debt that we will take, which Atraco's cash flows itself will be more than sufficient to fulfill that debt obligations.
All right, and have there been any client of late? How are your order inflows shaping up with your newly onboarded clients?
So we onboarded two customers early this year, one US and one UK, and both of them are shaping up very well. In fact, we are getting fairly good traction. These are early days because these customers are about 4-5 months old only in our system, and they are showing good promise and good growth. So very, very heartening to see how we are ramping up with them.
Good to have you on board. Thanks so much for taking time out and joining in.